there's this crazy thing called par value on stock. And when a company decides to become a corporation, they file what's called articles of incorporation with the state where they're located. And in that document, many states require them to put what's called a par value for their stock. This is like this sort of outdated thing that not every state requires, but many do. And it's arbitrary, meaning it doesn't mean anything. So if I say the par value of my stock is $1, that has zero to do with what my stock is actually going to be worth or what people are willing to pay for it at the market. But because we're structured that way, we have to account for the par value of our stock in addition to any money we receive from issuing shares over and above that par value. Okay, and so that creates some confusion. So just recognize down there below, it says there's these classes of stock. One is called par value. And I'll try to give you an example so it's less of a confusing concept, but par value is just this arbitrary amount we assign. Sometimes you'll have stock that's called no par value because the state it was incorporated in doesn't require them to put a par value. And some states call it stated value, which is in essence pretty much the same thing as par value, just some arbitrary amount that the state required you to put on the articles of incorporation. It's funny how many things we do in the world, even in the church, are because we've always done it that way, because this is the rules. One of the things I love about what President Nelson has been doing is I think he's really been looking at a lot of things we've always done a certain way and asking, do we have to do it that way, right? Is there any doctrinal reason that women can't be witnesses at baptisms? And the review said, no, there's no doctrinal reason. So let's open that up. And so I hope that the state governments will follow suit and get rid of this par value concept, but there it is. All right. So the stockholders' equity, we learned in the first chapter that assets equal liabilities plus stockholders' equity. And stockholders and assets are pretty easy to put your finger on, like that stuff that the business owns, and liabilities is pretty easy. That's debts that the business owes. But stockholders' equity is always kind of confusing because it's just the difference between those two. And so if I have more assets than I have debts, my stockholders' equity will be higher. And if I have more debt than I have assets, then my stockholders' equity could be lower or negative in theory, right? And so the idea is this, that stockholders' equity comes from two different places. One place it can come from is when the business owners put money into the business, like I just described, funding my business. That's what we call common stock. Common stock is what we call paid in capital, or capital paid in by the owners into the business. The other form of stockholders' equity is what's called retained earnings. That means when the business earns money and doesn't pay it out to the owners, then we retain those earnings in the business. So that's where stockholders' equity comes from, and that's how we fund a business. We either have to put it in as owners or have the business earn money and then don't take it all out. So here's an example of what it looks like when we issue stock at par value. So our example is on June 5th, Dylan Snowboards Inc. issues 30,000 shares of $10 par value stock for $300,000. So the way we record that transaction is we haven't really learned about debits and credit entries yet, and we won't until we look at Chapter 2 stuff. But we're going to debit or increase our cash account by $300,000, and we're going to credit or increase our common stock account by $300,000. So just recognize that when we issue common stock for cash at the par value, our cash goes up and our common stock account goes up. Remembering that common stock means money put into the business by the business owners or the shareholders. But sometimes we will be issuing stock at an amount greater than its par value. This happens when the people who are buying the stock at the market think it's worth more than the par value. So now, again, we're left where we have to account for the par value of the stock and any money paid in excess of that. So in this case, on June 5th, Dylan Snowboards issues 30,000 shares of $10 par value stock for $12 per share. So when we record that transaction, we're going to say 30,000 times $12 is 36,000, 30,000 times $12 is $360,000. And then we have to record our common stock at the par value, which was only $10 a share, is $30,000. And then our paid in capital in excess of the par value, any money we received in addition to the par value, we record separately. Let me pause here to say, I'm not a formal person. If there's something that just is really confusing you and you want to ask a question, just jump right in, like just interrupt me. There's not an easy way to I mean, you can put it in the chat if you're too nervous to, like, say, speak up, but there's not a lot of easy ways with Zoom to always make your voice heard. So if you're sitting there feeling really confused, don't be afraid to jump in with a question. All right. So this is what a little part of our balance sheet would look like after we issued that stock. You would show common stock, $10 par value, with 30,000 shares issued and outstanding is 300,000, plus the paid in capital in excess of par in the common stock, plus our retained earnings. So that gives us our total stockholders' equity of $425,000. That's what the stockholders' equity section of the balance sheet would look like after we issued that stock. And remember, issuing stock just means receiving money from owners. Okay. Sometimes it comes up that we issue stock not for cash, but instead for non-cash assets, like we exchange stock for land or we exchange stock for equipment. So in this example, they issue 4,000 shares of $20 par value stock for land that's valued at $105,000. So again, we show the asset land going up by $105,000. And if it's 4,000 shares of $20 value par value stock, then we know that that means $80,000 is the par value of those 4,000 shares. So we record that. And then any value over and above that par value, we have to record separately as paid in capital in excess of par value. So we can issue stock not only for cash, but also for other assets.